Hello and welcome back, guys. So, in this particular session, what we will be covering is SPR's exam kit. So, what we'll be looking at is this specific question, which is about trailer. Okay, so background and financial statement extracts are given. Trailer is a public limited company, operates in manufacturing sector. Trailer purchased an investment in part during the reporting period. Drafts of the SOFP at 31st May are as follows. So this is trailer and then this is park, okay? And then the following is relevant to the preparation of group financial statement. Trailer has made a loan of 50 million to charitable organization for building of new sporting facilities. The loan was made on 1st June 20x2 and is repayable on maturity in 3 years' time. The interest on the loan is 3%, but Trailer assesses that an unsubsidized rate for such a loan would be 6%. The first interest payment was due on 31st May 20x3. Okay. Trailer initially recorded a financial asset of 50 million and reduced this by interest received during the year. The allowance has been correctly dealt with, right? So what we are required to with suitable workings and discuss with suitable workings how the loan to charitable organization should be dealt with in the consolidated statement for the year ended 31st March 20x3, right? So loan to charity, right? Loan to charity. So what's our loan? So first of all, what we'll do is that let's discount the loan. Let's bring it in present value, okay? So cash flow 1, 2, 3, I think 3 years, right? Cash flow would be how much are we receiving? 50 into 3%, I guess 53%, right? So 50 into 3 would be 1.5, so is equals to 50 into 0.03. 1.5, copy paste and then copy paste, but plus 50 as well, right, in the last year. Isn't that correct? In 3 years time, right? Okay, that's good. So discounting factor, right? So what was the discounting factor? 1 divided by 1.06 to the power this. Copy, paste, and then NPV, net present value, is this into this. So copy, paste, and then our total would be sum of all this, right? So 49.99, so that means 46, right? So this will be our opening balance, and then after that effective interest rate, interest received, closing balance. So our opening balance will be this figure, and then our effective interest rate would be at the rate 3%, no, 6%, 6%, right? 6%. So this figure into this figure, and then interest received would be it's 1.5, right? And then this plus this minus our interest received, right? So our closing balance will be this much. This much should appear in our SOFPE, right? Isn't that what we are? So what did trailer recorded? It recorded a financial asset of 50 million. That means, and reduce this by the interest received during the year. So that means it recorded 50 and then minus 1.5. That's what it did, right? So that should not be the case, because we need to, because at the end of the period we are still only being paid 50 million, right? Okay, so as per IFRS 9 financial instrument, financial instruments, financial, the asset for us should be initially measured at fair value according to IFRS 13 fair value measurement. This is the selling price of an asset in an orderly transaction between market participants, right? The market rate of loans market rate of loan on interest is normally 6%, whereas for the charity it subsidized has been subsidized, so only 3% is being paid. This is not indicative of the assets fair value. So it is determined by counting all cash flows at normal market rate for a similar instrument. And after that, what did we get from there? Is we got this, right? So our net present fact value is 46, right? So 46 is there, and then what did the question make mistake? So they initially recorded a financial asset of 50 million, right? So this should be corrected. The financial asset recognized financial asset recognized is $50 million, which is incorrect. So it should be reversed. Should be debit, profit or loss, $4 million, credit, financial asset, $4 million, right? And then after that, what did we get is we prepared this table, right? As per this table, how much okay, before doing that, let's talk about something else. Before classifying any financial asset, asset business model test should be done as per IFRS 9, right? For IFRS 9, since the business model is to hold asset to maturity, collect the contractual cash flows, contractual cash flows, right? So any interest received would be credited to SOPL using effective interest rate, and the cash receipts reduces the carrying amount. All right. All right, so what did it actually do was, how much did it actually record? So it recorded 3, right? So how much were we supposed to want? So okay, so let's do something else. 3 and then 1.5, right? That being same, so 2.75, that means 2.8, right? So it has not yet recorded anything of that sort. What did it do? Recorded a financial asset of 50 million and basically reduced this by interest received during the year. Okay, so interest received is 1.5 over here as well, over there as well, it's the same, so it did not affect. But what we need to do, another entry is debit financial asset, $2.8 million, and then credit profit or loss. This is finance income, okay? 0.8 million, right? That's it pretty much, I guess. Anything in SOFP? So what will it so is that in SOFP this figure will be reported, okay? So financial asset would have a balance, would have a carrying amount of 47.2 million, right? Okay, that's basically it. And then discuss how the restructuring plans should be dealt with in consolidated financial statement, right? Trailer has announced two major restructuring plans. The first plan is to reduce its capacity by closure of some of its smaller factories, which have already been identified. This will lead to redundancy of 500 workers who have all individually been selected and communicated with. The cost of this plan are 14 million in redundancy cost and 4 million in retraining cost. Okay. The second plan is reorganize the finance and information technology department over 1 year period, but it does not commence for 2 years. The plan results in 20% of finance staff losing their job. During the restructuring, the cost of this plan are 10 million in redundancy cost, 6 million in returning cost. No entries have been made in financial statement for the above, right? So restructuring cost, right? So IS 37, right? Control B, number 2. So should we create a provision or not? Isn't that the question? Isn't that the question? Yes. Should be dealt with, right? It's basically something to do with provision for restructuring, right? As per IFRS, no, IFRS IS 37 provision contingent liabilities and contingent assets provision is recognized there is an obligation from past activities, past event, outflow of economic resource is probable. Economic benefits is probable. Okay, benefits, that means more than 50%, right? Probable. And then the outflow can be measured reliably. Since the first plan, so it's already been communicated, right? Isn't it? So first plan, it's communicated with, right? So that means it's already been announced. So that means we need to create a provision. Okay, has already been communicated. So a constructive obligation arises to incur the expenses, to incur the restructuring expenses. Okay, sharing expenses, not B, man. Effective. IAS 37 also mentions that cost can only be included in restructuring provision they directly if they result directly or are necessarily entailed by a restructuring. Okay, so if it is related to restructuring, then only it can be classified as restructuring expenses. Okay, in this specific case, only employees redundancy costs are provisioned, whereas ongoing activities such as relocation and retraining is not included. So only provision for the redundancy cost of how much million is that? 14 million, right? 4 million is retraining cost, so that's not included. So that means only 14 million is recognized. So entry would be, how would you recognize a provision is profit or loss, credit, provision, 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 right? This will be 14 million. Same thing over here as well. Total 14 million. That's it. In second case, right? So in second case, what has happened is that it does not commence for 2 years. The plan results in 20% finance staff losing their jobs, and then the cost of this plan is 10 million, and then no entries have been made, right? So what we need to figure out is that, is there a present obligation? Let's give a discussion. In this case, in the second plan, 20% 20% of the finance and IT department employees will lose their job, right? It will, however, plan will only start after 2 years. Start after 2 years. However, given the long time span of 2 years, the plan may change significantly, and details of employee being made redundant is not specific enough to create a redundancy provision. Okay, should be your answer. Okay, so after that's also done, so it's not recognized, right? So no provision is recognized. Let's move on to third number question. Third number is about what are we required to prepare the equity section of SOFP, right? Equity section of SOFP. Okay, section of SOFP, right? So what we will need for this is, so let's go back to our spreadsheet. So what I'll do is I'll just move it to the side. Might need few of these. Working note number 1, group structure. So what's our group structure? Parent and subsidiary. Parent and NCI. So on 1st June 20x2, that means exactly 1 year earlier, right? May, June, yeah. 1 year ago, 60%, and then acquired of Park, a public limited company. The purchase consideration comprised of cash of this much. Okay, 60 and 40. Let's write that down first of all. 60 and 40, right? This is in percentage, and then it should be 60 and then 40, and then working note 2, calculation of net assets, right? Of subsidiary, and then working note 3, calculation of goodwill. Calculation of goodwill, bolded as well. Cost of investment, fair value of investment, NCI, less net assets at acquisition, ACQ, which is from working note 2, right? And then after that, goodwill. Any impairment, anything like that, we will definitely keep it over there at ACQ, at reporting post acquisition, right? So put in the figures. Net assets was 19350, right? Purchase consideration 1250. It was only cash 1250. Okay, so what items do we have over here? Let's look at over here. So share capital, return earning, all the component of equity, right? So share capital, retained earning, other component of equity, and then after that, so there might be fair value. Okay, so our total net assets, it should be in bold, right? So our total assets is already been given to us. So 1950, right? 1950, isn't it? 1950, and then return earning was 650. 1950, 1950, and then after that 1950, 650 and 55, 650 and 55, 5, right? and then anything else that we are given. Excess is due to plant and machinery which had a remaining useful life of 7 years at the acquisition date. It is group policy to measure the non-controlling interest at acquisition at its proportionate share of fair value of subsidiaries net assets. Okay, so no, not fair value of goodwill. Okay, so let's do something over here. So what we need to do is that let's find out the retained earning first of all. So 930 and 930 and then 80, right? And then this figure is 1210. 1210. 1210. This figure will be sum of everything, sum of all this thing. So what's our fair value adjustment? This minus this minus this minus this. So 35 is our fair value adjustment. So this figure will be same from here for plant, and then it will have excess depreciation, right? So since it is a plant and machinery, so useful life of 7 years. So how many years has gone by? Just 1 year, right? So excess depreciation for 1 year only. Excess depreciation for 1 year only. That means minus this divided by 7 into 1. Okay, so that is done. Our net assets is this figure. Goodwill is only for parent. Okay, this is only for parents. Parents goodwill. And then this figure is this into 40%. Okay, that's what the question says. So our goodwill will be this minus this 80, right? Goodwill is also there. So what do we need to prepare? We need to prepare. Okay. Has there been any impairment? We need to look at that as well, isn't it? What about NCI? We need to prepare that as well because we will need it in equity section, right? So let's prepare fair value of net assets. Working note 4, I mean non-controlling interest, calculation of NCI, right? So this figure is same. Control V, come on mean, figure share of post acquisition profit, which will be this figure into 40%, right? So I have not calculated this figure, so I'll quickly do that. Minus this, copy, paste for all this thing. So what else is there? So impairment is not there. Any PURPs, any, that's already been accounted for. Okay, so I'll just leave few more lines and then do another thing. Working note 5, bolded calculation of group reserves. Bolded 100% of parent, and then share of post acquisition profit. How much is parents? 1240, right? 1240 and then this figure will be 300 into this figure 40, not 40, I mean before. Isn't that before? Yep, it's before. And then there will be less something else as well. Working note, let's keep a bit of gap. Working note 6, other component of equity. How did it change, man? How did it change? Okay, calculation of other component of equity. Component of equity, right? Okay, so bold it and then let's calculate few more things. One more thing that we need to calculate is what has been the impairment. Okay, working note 5, 7. Okay, working note 7, bold it, calculation of impairment. Impairment, bold it. So what's our goodwill? First of all, we need to find out goodwill. Parents goodwill is this figure, right? 80, which is 60%. So NCI's goodwill will be, if this is 60%, then what we do is that this figure divide by 60% into divide by 60 into 40, right? So this will give us our total goodwill. Total goodwill, right? So total goodwill is this plus this, and then what's our carrying amount of so net assets of this is before that date. Okay, so carrying amount of net assets is this figure, right? So this will give us the total valuation for the company, and our recoverable amount is less recoverable amount being how much? 2083, 2083, 83, right? Okay, so this will be this figure minus this figure, right? So this is our, what is it? It's our impairment. Impairment. So that means there has been an impairment greater than goodwill. Okay. So once that's been exhausted, then only it will move on to other, right? So since our goodwill is 133, so since our goodwill is 133, remaining assets that we need to allocate it will be 167, right? So impairment will be 167. So this will be 167, and then this will be divided into two chunks, which will basically be less impairment of other asset. This will be this figure into 40%. B5, B5 I guess, B5, and then impairment of assets in this case will be no, impairment of goodwill. Okay, this whole figure, impairment of goodwill. So less impairment in other assets, right? Less impairment in other asset will be parent's goodwill is only 80, right? So only 80 will be exhausted. Okay, and then rest will be charged against, which is 167 into 60% into before, right? This figure should be in minus, even this, even this. Okay, right. 247. So how much is missing? It's basically shit. What we did not do over here is that we eliminated this minus this. That's pretty much what we did. We did not basically charge that against the NCI's portion. Okay, so leaving that aside, let's figure out our other component of equity as well. So what has happened with other component of equity? Parent. So what's the parent's other component of equity? 125 and then 80, right? 125 and then subsidiary will be, how much is subsidiaries thingy, other component of equity? It will be basically this figure. Okay, this 25, no, 25 into our share only. Okay, so that is 60%, right? Before 15, right? So our other component of equity will be this plus this figure. And then what we need to be careful about is, let's move it a bit below, is what are the adjustment that we made earlier. So all this adjustment needs to be allocated. Okay, the financial asset recognized is 50 million, which is incorrect, right? So what did we do? We need to reduce group reserves, right? Financial asset, financial asset, financial asset. So financial asset is down by 4, right? And then what else? 2.8 is our finance income, right? So that will be our positive figure. So let's add interest income 0.8, right? And then after that, what else did we do? On second we did a provision, right? So that will basically reduce our thing again, provision. Provision. Okay, so minus 14, right? So our total will be 122.4. So what did we do is that we need to eliminate few things. Sum of everything minus this, because that's not part of other component of equity. It's always confusing when there is other component of equity. Okay, so what we need to basically do is that this movement in other component of equity should be separated out. Okay, the one that I'm highlighting, it's separated out. It's not we assume that it's not within its part. Okay, so what I did over here is that I only took the changes for the changes in share capital, return earning, and fair value adjustment. Okay, not the other component of equity, because if we do that, that will also be allocated towards the other party, so we don't want to mess it up. Okay, that's why. Okay, after that's done, I think we are good. So let's prepare our SOFP then, first of all. So SOFP, equity shares, right? Share capital, return earning, other component of equity, and then NCI. So this will be working note 5, working note 4, working note 6. The share capital will be, where did that figure go? Will be this figure, right? 1210, has it already been recorded? Has it already been recorded? So our share capital, and up it's 1750, because we are 1750, we are parent, right? So this will be this figure, that's the total, and then other component of equity will be our total figure from here, and then our NCI will be figure from here, right? So let's calculate that figure as well. Right, so let's sum it up. Let's plus this. This is our total equity. Bold it. So what has happened is that something else has happened, so we need to change this figure. For NCI, for in case of NCI, since we eliminated that figure, we need to add it up as well, okay? Yep. So for NCI, what we need to do is that bracket plus 25, okay, since we eliminated that, but for NCI it's not yet eliminated, okay? And that's how we basically do it, right? It's just good way of presenting it, that's all, okay? Otherwise it's pretty. And then why we are eliminating that is from here, is that from this figure is that we only account for parents share, okay? Because see, what happens is it's 140 over here, right? So that means this should increase by 140, right? So if we were to take this figure and then after that, let's say plus 25, see, it changes, right? Changes the whole thing. So out of this 25, 15 would have been added, but we need to present it separately, so we present it separately, okay? That's what basically the question asks. Since that's also done, so let's rename this trailer, right? I think we are good with equity section. Equity section is in spreadsheet, right? Spreadsheet. We can do the explanations, not a big deal, just explaining the numbers. The only explanation that we need to give is only in case of other component of equity and in case of impairment, right? And then let's move on to P number, right? P. So what's question number B? NCI at fair value. So the explanatory with suitable calculations, the impact on financial statement if goodwill arising on acquisition has been calculated using fair value. So impact of measuring NCI at fair value. So what we'll do is that we'll continue this in second part. Okay, guys. So until that time, bye bye.